And the catalyst from negative to positive, was it the jobs data?
I think it was more than the job numbers because, in fact, if you have a look at the bond markets as well as the Aussie dollar, we actually saw a negative reaction. It was only the equity markets which seems to storm ahead today. The market was up by 0.3%. I think it's because if you have a look at the job numbers, well, the headline numbers was extremely positive. The details were where the negativity came through, and especially in the full-time jobs where we saw a loss of 9,200 jobs. It's the third month we've actually seen a decline on the full-time job numbers, and that has an implication in terms of household income and household wealth as well. So if we have a look at the Australian market and see what drove it, well, I don't think it was so much the jobs as it was earnings. We saw the defensive and the high yield as the big winners on the market today. In fact, if we have a look at just three stocks, and that's National Australia Bank, ANZ and Telstra, those three stocks were responsible for 75% of the gain today. Of course, we saw NAB coming out with first quarter numbers. That stock was up by 1.9%. We saw Telstra gaining 1.2%. On the flip side, we also saw some negative reactions, but these were some smaller stocks on the market. The biggest one, I guess, was News Corp. We saw it down by 3.2%. Mirvac also down by 2.2% after announcing write-downs. And we saw Webjet losing ground after its results as well. So earnings very much in focus, and the fact that we saw two very big companies on the Australian market with some positive numbers coming through meant that the Australian market had a wonderful day. We also saw some highs for stocks, and they were partly driven by earnings. We saw REA reaching a 52-week high, and that's, of course, a stock that's come out with earnings this week. NAB also reaching a 52-week high. CSL reached a 52-week high today, as did Flight Centre. So all in all, a good day for the Australian share market. The market just shrugging off the implications of the negative detail coming through from those job numbers, and the market going once again to that 50% retracement level to test that 4,986 point mark.
Is it as attractive to you now as it was going back a few months? I mean, at this price, is the dividend yield still attractive enough, and do you see the capital appreciation?
The dividend yield is attractive. The capital appreciation side is more questionable, and that's because I think the positive and the growth in Telstra has already been priced in. The growth that's going to come from 4G, the growth that we are seeing in mobiles is being priced into the stock price. The stock's up 35% in the past year. One of the positive catalysts that could come through for Telstra and its share price is, as Martin mentioned, an increase in dividends, and I think that's really what the market's starting to focus in on. Telstra once again declared its 14-cent dividend as per usual, but one of the measures which absolutely jumped this time around was free cash flow. Free cash flow hit $2.2 billion. It was up by 20%, and free cash flow is expected to continue to be quite strong, and that, of course, has started a bit of speculation around whether we could see a dividend increase. So that's really helped Telstra. Telstra was also an important one because it was I guess the first big high yielder off the ranks in terms of reporting. It's managed to fly through with flying colours with an increase of about 1.2% today. So that really does bode well for some of those high yielders which have risen so strongly over the past year. NAB's the other one that came out today with a rise of around 1.9%. I guess what is a little bit more concerning is some of the cyclicals that have run quite hard. I mean, if we have a look at some of those cyclicals, Seven West Media is up by 40% in the year-to-date so far, and we're not even through the second month of the year. We have a look at stocks like Myer, that's up 20%, Billabong, Pacific Brands, that's up about 18%. So I guess we're watching the cyclical end a little bit more closely, and I have a sneaking suspicion that investors perhaps may return to stocks with more predictable earnings and with a clear growth path, like Telstra. It's grown earnings at 8.6%. The mobiles division is doing well. The possibility of a higher dividend, and Telstra's share price at the highest level that we've now seen since June 2008.
Julia, it's Martin. I just want to go back to Telstra for a moment, if we can. What's interesting is that 30% performance by Telstra really is all about yield re-rating, not so much on the earnings side. And I don't disagree with you at all. The outlook on earnings for Telstra is not negative, but it's not really going to shoot the lights out either. But interesting when you think about it, cash rates were, when they were 4.5%, the yield on Telstra was 8%. Differential about 3.5. The differential is almost the same. We currently got Telstra on a yield of 3% and cash rates at 3. So almost the same differential. So that's why we think there's more upside in Telstra, because the market is going to continue to chase high quality yield, and if cash rates fall to 2%, which is Macquarie's forecast in 12 months' time, Telstra will be $5.20.
It's a really good point, Martin, but I guess traditionally what happens during the cycle is at one point in the cycle we get a shift, and most investors shifting from defensives into more of the cyclicals. Now we've started to see a shift into cyclicals, but the defensive area has still remained quite popular and quite strong, and I think that this is going to continue more because of the demographics of Australia and the structural shift that we're seeing. The baby boomers coming into retirement mean that income type of assets will probably become more popular, and this is a trend that we'll see develop over the next decade. So yes, interest rates continue to fall and those high yielding stocks very much in demand. The cyclicals also in demand, and they're both running very strongly together, which is quite unusual. Maybe this is an inflection point, but also I think there may be some structural issues at play with the baby boomers coming up to retirement, that there could be a more demand for income assets in the next decade.